Let me also bring on board Vikas Khemani, founder and CIO at Carnelian Asset Management and Advisors, joining us this morning. Vikas, hi, very good morning, and great chatting with you on a day like this. We've seen a bit of a fall on Indian indices, more than a bit. I mean, we're down maybe 15% odd from the recent highs of 26,300. Question is this a good opportunity to buy given the circumstances that are playing out and the uncertainty that is there?
Hi, good morning. I think clearly we have seen with unprecedented time in the recent past, which has led to this kind of correction. And, we've seen this kind of situation even before in 2022, when Ukraine war broke out and we had a 2-3 months period where markets were kind of very, very, uncertain, what will play out in the future, how the oil prices will react, all those worries which today we are facing were pretty much there. I think one good news is that, till last week, there was a big worry that how far it can escalate. Can the energy infrastructure be destroyed? Can we have a long-drawn energy crisis? Looks like that from the yesterday's statement from Trump that, he cannot afford, or he has a pressure to kind of wind down this war sooner than later. This is just my assessment. So it looks like that it may not go on very, very long. And sooner than later, you should try to find some resolution. And if that's the case, then this definitely offers a good opportunity. So if anybody who's willing to invest from 2 to 3 years perspective, this vintage will play out really very good, in my opinion, because these are the times when you get good prices of the stocks which you've been buying, and these uncertain times offers a great shopping opportunity. Unfortunately, that's the time when the risk perception is also very high. So I feel that especially post yesterday's development, it looks like that war is going to be resolved pretty much sooner than what market anticipate. And if that were to happen, then it could be a good sort of bounce back from here over the next couple of months.
You're sounding very, very bullish, Vikas, but I'm going to have to pause you there before I ask you as to what is it that you're liking. Actually, we have an exclusive coming our way. We're learning from government sources that the process to finalize the guidelines for PLI 2.0 for smartphone manufacturing is in its final stages and will be announced soon. Sumita Karir joins us with all of the details on that.
That's right. We're given to understand from sources that government has expedited the process to finalize the contours of PLI 2.0 for smartphone manufacturing. And smartphone manufacturing is something that has picked up rather well in this country. In fact, if we look at electronics exports overall as a category over the past couple of months, particularly, it has remained in the top 5, or rather the top 3 items of exports from India. So MeitY has fast-tracked interministerial consultations. In fact, stakeholder consultations are also currently going on. The government is talking to key industry players, to other key stakeholders, and these are likely to be completed by April this year. In fact, various new components are likely to be added as part of this scheme. However, the total capital allocation, the total capital outlay, many are suggesting, sources have suggested, that this is likely to be less than ECMS, or the Electronics Components Manufacturing Scheme. However, smartphone players like Apple have pitched for higher budgets, which is similar to PLI 1.0. In fact, the other aspect of this is also the fact that this is coming on the heels of government easing PLI 3 norms. So, of course, Chinese smartphone players will also be allowed to participate in the scheme, provided that they allocate sufficient budgets for local value addition. So local value addition is going to be key. Of course, the current PLI scheme, which ends this fiscal, has attracted global major players, as we have seen, including Apple's contract manufacturers, Foxconn, and of course, Samsung. These smartphone companies are building in India. And in fact, not just building in India, but India has emerged as a key player, as a key destination for manufacturing for these companies.
Thanks, Sumita, for that exclusive. Vikas, how do you look at the EMS space in light of the fact that the government is now looking at PLI 2.0 for smartphones?
Sorry, which space? I missed your point.
I'm saying how are you looking at the EMS space, companies like Dixon and others, especially after government is looking at PLI 2.0 for smartphone manufacturing in India?
I would not comment on the companies, but I think generally speaking, it's good for the sector. I know any incentive by the government to push for the more growth is always positive. But of course, you have to look at individual company, their valuation, growth journey, and then start evaluating. So far, we don't have any exposure to this sector because we find that valuations are very high, but we keep evaluating.
Point taken, Vikas. So what is it that you're finding attractive? You clearly said that this is an opportunity for the next 1 to 2 years for those looking to buy. Give us a tilt of what are the pockets that are looking good at this point?
I think one of the biggest, in my opinion, beneficiary of this, or if that environment were to change good, banking could be very, very, big beneficiary because it has the least linkages from a long-term perspective. The growth is kind of reasonably all right. Valuations have corrected significantly. We are finding interesting, value out there. And again, leverage to the domestic economy. Once this settles down, I'm sure, the sector should do well. Similarly, I think there are sectors like, aviation, where, in my opinion, again, because of this current situation, stocks have corrected a significant beating. And, as the dust settles down, because there's a sectoral tailwind in terms of growth, and oil price coming down again will augur well for the sector. So something like that could be interesting. Within manufacturing space, there are opportunities which are emerging. So I think again, the ideas don't change very often. But what, according to me, is sectors which have kind of got decimated, or some significant correction which I've seen in this down cycle should be looked at, which have got impacted because of the perception of risk. But as the risk winds down, what could come back? But generally speaking, at least we from a portfolio perspective don't make changes very often. We have not made changes because of this war. Of course, significant changes. Most of our sector allocation continues to remain same: banking, pharma, CDMO. Some of them are kind of fairly large position for us.
Interesting. Vikas, what keeps you bullish with regard to banks? Because pretty much all of the private sector banks have their own individual concerns now. We've had, of course, a large correction, but growth is certainly a concern. There's also a possible argument of a shrinking profit pool, given that PSU banks are willing to do the same business at a far lower profitability metric or ROA, and therefore maybe there are those concerns emanating. Do you believe that those concerns are short-lived and it's just cyclicality playing out?
I think, see, first of all, there's no case for, in my opinion, I mean, we have seen credit growth picking up in the banking sector, last 2 quarters. So I think if economic growth has to grow, credit growth has to grow, banks have to grow, right? And of course, last year, because of the NIM compression, there was a sort of a little bit of a slowdown in the growth, but we think that that's behind. And as we look forward, you will see, banking sector growing. Again, there could be company-specific issues. I'm not going into company-specific, but in general, many banks can grow between 12 to 15% kind of earning growth, and some can be even more. So given the valuations they are at, in my opinion, there are interesting opportunities because they are the large sector, and they also took the beating as the market sell-off happened due to this current risk. Once the risk settles down, obviously they would be leading the rally accordingly.
Because how are you looking at the NBFC space? In the sense, the borrowing from the market, it's happening at 11% yield for many of the smaller NBFCs. Is that a stress going forward for many of the NBFCs?
So we don't invest into the smaller NBFCs because we think that those business models are inherently risky. We typically invest into only large AAA kind of rated NBFCs, and we have fairly large exposure to Aditya Birla Capital, which has done very well for us. And I think those franchise continue to remain very solid, continue to remain very well placed in terms of their borrowing cost and their ability to kind of make money after only kind of taking very limited risk. So in that sense, we like that pack. But any business NBFC which has a very high cost of borrowing have to chase very high yield, which means that those assets which you are chasing are inherently risky. So we basically always avoid, in a leverage business model, risky asset class. It's not that we don't like that. I'm sure there are people who like it. So we prefer to stay in those kind of NBFCs.
Okay. Vikas, how are you playing pharma? You touched upon it a little bit. Probably that's one way to play domestic manufacturing as well as an entire theme. But what's the tilt like? How do you kind of segregate the wheat from the chaff? Just give us a perspective of that.
Again, each company has to be looked at differently. Pharma is a very wide space, but within pharma and CDMO is something we've been very bullish as part of our manufacturing theme for last 2 years, and we think it's again a very long-term theme. So that continues to remain a very focused exposure for us. Biosimilars are again a very a large opportunity as over the next 5 to 7 years. That's the one space we have a fairly large exposure. Within other segment for specialty pharma companies where it has both exposure to domestic as well as the international exposure companies, we have taken those companies in all. So I think you have to look at pharma in terms of individual portfolio, but in general we think that domestic pharma is going pretty well. Internationally there could be some better environment going forward, and that could kind of drive the performance for the sector well. And also it is a kind of defensive sector in uncertain times. So, that has helped us also in this difficult time over the last couple of months.
And what do you think of power, Vikas? Because that's the other big theme which is actually doing very well in a market like this. The Nifty Energy Index is actually outperforming. How would you play power? There are just so many ways of playing it. Would you play it through transmission, through the power gencos, through the power ancillaries, through the power lenders? How should one play that?
There are multiple ways of playing it. We've been playing through players like PHL. We've been playing through players like Kalpataru, which is into transmission. So we've been playing through that because I think power is definitely a very big segment, because as we have the more and more growth, economic growth, as well as the data intensity, so consumption of power will go up. There's no doubt on that. Not only in India, globally. So this sector is not only probably good looking from a domestic perspective, but from an international perspective as well. Hence, I think probably the next 3 to 5 years, it should be in a good situation. And the different plays, we still have no way to play that data center kind of game. So I think you play with ancillaries, you play with enablers, you play with, which is what we have chosen to play so far.
Take with regard to IT, how much of that pain has already been built in? Give us a sense of that. And we'll very soon have, maybe in another 15 days or so, start having commentary coming in from IT companies for Q4. Do you expect that to possibly be a trigger point for a possible return or upside within this basket?
I think a lot of beating has happened. In my opinion, it's slightly blown out of proportion. There's a little bit of overreaction. Of course, there's no denial from the fact that AI will change the world. AI will change the way we operate. But that does not mean that IT industry business model is wiped out. I mean, all IT companies, large IT companies have, evolved their business model over the years in line with the technology changes. In the enterprise context, you need a partner to implement whatever technology is there in your organization. And that's where I think, most IT companies which are able to adapt will be the winner. But having said that, it is wrong to assume that IT sector business model will get wiped out. In my opinion, that's a wrong assumption, which I think probably market. And I don't think it will also have a huge impact in the growth, because every company needs to spend more in terms of, making themselves, enabling themselves for being AI ready, right? So, and these are not, short-term projects, they are very long-term projects. So I'm quite, sure that it's not as bad as, but yes, companies will have to, adapt themselves, and winners will be ones who adapt. And that is where the key thing is, that to identify companies which are winners out of this whole transformation.
And Vikas, the last I checked your portfolio, you had a very large allocation in oil and gas as well. Talk to us how you're playing that theme, because it's been so choppy with regard to crude.
I think probably you got it wrong somewhere. I don't think you've ever had exposure to oil and gas. So maybe you kind of, it's not true.
My apologies. How should one play auto and consumer discretionary at this point? So I'll give you a sense of what's probably playing out. On ground, there's reports that Asian Paints has hiked prices. And of course, crude is elevated at this point. And 6 to 8% price hike by Asian Paints. Of course, it's a very competitive market. Paints in particular. How are you playing consumer discretionary, and if you have any view with regard to paints?
I think, see, again, all these kind of short-term movement would be there. I'm not, going into that, but generally consumer discretionary is well placed. especially post GST cuts last year, we have seen a good traction happening. Also, it is linked to the per capita income of the country, which is growing steadily. So I think generally speaking, the long-term trend is good. Again, I would say that we've only struggled with a lot of valuations in the sector for many of the companies. So if you find a company which has a reasonable valuation and reasonable growth, then sort of that makes a lot of sense. So in general, we are positive on the cycle. Automobiles, we have had long exposure for a very long time, across CVs, PVs, and two-wheelers, which will continue. We think that, that's likely to still continue for some more time. So you just kind of, play out between risk reward of, generally at this point in time, we are positive. But again, I would say directionally sector positive, but you have to be very stock specific in terms of finding your idea on that.
Vikas, I get where that 15% from oil and gas is coming from. I just pulled out your fact sheet. 10% is from Reliance Industries and around 4.5% is from Petronet. So that's where it's really coming from. Apologies for that. Yeah, so I just kind of pulled out the breakdown there. But understood. Vikas, just last off, you also got a call with regard to metals. It's a very complicated geopolitical environment. Indian balance sheets where metal counters are concerned are much better than where we were maybe maybe during COVID times. Do you believe that a larger metal rally may be warranted at this point, or do you believe valuations are largely steady state and have priced in most of the kind of gains that we've seen?
Metals can still have some more rally, because I think as and always post-war situation, you will always find more and more build out happening. And in general, I think there's a reasonably good momentum towards metal. So I think that we don't invest into much into metal, so we don't have any exposure. But in general, if I were to comment that, I think probably it has a little bit more legs to go.
Thank you so much. You've been gracious with your time this morning, but it's a critical time and getting your view was super important. So thank you so much for coming in and giving us that perspective.